This is the Starkey Multifamily Podcast. I am your host, Reed Starkey. Today I have the guest, Gino Barbaro. Thank you, Gino, for being on the show.
Reed, thanks for having me on. Appreciate it.
All right. So Gino is an investor, a business owner, an author, and entrepreneur. He has grown his real estate portfolio to over 1,100 multifamily units. He is the co-founder of Jake and Gino, a multifamily real estate education company that offers coaching and training in real estate founded upon their proprietary framework of buy right, manage right, and finance right. So Gino, let's tell everybody a little bit about yourself and how you got into real estate and into your first multifamily deal.
Well, Reed, I think I got into real estate like everybody else. Hated my job. I owned a restaurant for over 20 years, right? So everyone thinks it's a glamorous business. You turn on the show and you see all these idiots on TV cooking and all like that. It is not glamorous, especially when you're a mom and pop like I was. I was raised into it. My dad had a restaurant. And then back in 94, I partnered with my brother. We bought our restaurant. Owned it for over 20 years. I retired 3 years ago in March. So 3 years ago was the time I left. But, 08, 09 was a rough patch for everybody in the economy. And, restaurant owners, if construction guys ain't coming out to eat, then restaurant owners are going to suffer also. And that's when I took a deep dive. I said to myself, I want more. I have 6 kids. I need to put 6 kids through college. I need to feed 6 kids. My food bill is probably bigger than most people's mortgage, right? And it's just crazy. So I was panicking. You're working harder, you're making less, and it was getting to be annoying. But I'm saying to myself at the same time, why is everyone out there, not everyone, but there's a lot of people out there that are still making millions of dollars, and I'm not one of them. Let me find out why. I transitioned and went to life coaching, and that really helped me out. The personal development was huge for me. I had always been reading Tony Robbins and Zig Ziglar and Jim Rohn, but you can read them until you start listening and until you start getting clarity for your own life. You don't really hear the message. And when I went to coaching school, I figured out, we'd spoken off air about your why. I realized what my why was. My why was, I'm wasting time at the restaurant. I have God-given talent. I have God-given ability. I had great parents. I had no excuses to not be successful in life and not to, achieve or go towards my sole purpose. And I said to myself, I need to do something. So I said, the first thing I need to do is become financially free. My finances were okay. But I said, I need to find something where I can generate passive income and then start growing a business, not being a mom and pop. So that one restaurant, met Jake in 2011. He was a pharmaceutical rep. In coming to our restaurant, getting, orders for doctor's offices. And he saw the writing on the wall with all the layoffs. We met, we bought a property back in 2013, our first deal. And our first 1,000 units were all self-funded. We enrolled it. We've refinanced almost $9 million out of our portfolio and repurposed it into other properties. So the first 1,000 units, we did everything backwards. Most people start syndicating bigger deals. We just brought on another partner who had a good balance sheet, and we just bought ourselves. And that's how it started, just being disgruntled, wanting to take control and wanting to really create a business. So it's pretty weird that I had one restaurant for 25 years, and I've got, going to be approaching 1,500 multifamily units in 6. So.
Yeah, it's quite an accomplishment. So you say you didn't do the syndication in the beginning. So you had to have some money to get into that of your own, I imagine. So did that come from the restaurant business?
Came from a lot of sources. Our first deal was a $600,000 purchase. Me, Jake, and my brother I brought on because my dad was Italian. He says, you've got to take care of your brother. It's one of those guilt things, right? So I'm the older brother, so I had to take care of him. And our first deal, we needed to come up with, we got owner financing. So 10% down payment, 10% owner financing. So on our first 25 units, we had to come out of pocket $83,000, the 3 of us. I think that's a great deal, right? 18 months later, we refinanced that property. We pulled out 160 grand. So all that capital is back to us, and it's still printing $3,000 a month cash flow of that property, between $2 and $3 grand a month. So that's how we got into it in owner financing. Our second deal, we brought on our next partner, Mike, who's with us. It's just me, Jake, and Mike now in our own deals. My brother's got a small percentage. We brought on another partner, and that's what we started doing. We started scaling up. I used some savings. The third deal, what Jake did was he had no money left. He went to grandpa. He went to everybody. We actually paid Jake an acquisition fee for that property because it was 136 units. It was a big deal. He put the whole thing together. So out of that 2% acquisition fee, it was a $4 million deal. He rolled that in as part of equity. Our partner lent us $500,000 for the down payment. We paid him 5%. when we refinanced the property, we refied him out. So he was generous enough to actually, liquidate himself, or, on that debt, on that equity. He took less equity because he knew it was such an awesome deal. So we did everything we possibly could. And then on our fifth deal, it was 281 units, $11 million. That was all owner financed. I mean, home run of a deal. The reason why we did that is we had the plan. We had already been working. We had already our systems in place. A guy named Jim Clayton, who sold Clayton Homes to Warren Buffett, his bank actually financed the deal for us. It was a community bank. 20% owner financing on that deal. We actually walked away from the table with over $100,000 because of prepaid rents and some security deposits and some money for the due diligence. Title lady's like, I've never seen that before. I'm like, you know what? It's a great deal. The numbers work. They were super motivated. We've since then refinanced out, paid off the owner's notes, and we hold those properties. So there's so many different ways to get into it. And that's why we never went and looked at the syndication route, because like we can control our own destiny. We don't want to really bring in any partners. And maybe that was short-sighted. Maybe if we'd started syndicating after that deal and said, you know what, let's not be such equity hounds. Let's share the pie. We don't need as much money to bring to the table. We can share it with investors. We just weren't comfortable at the time. So maybe it was a lack of education. I learned syndication through our podcast. I podcasted Ivan Barrett. You can go down the list of syndicators that we've done: Michael Blank, Reed Goosens, Jonathan Twombly. I learned the model from them, and I said, you know what, Jake, let's try it. So after 6 years, in November of this year, that past year, we closed our first syndication. Think big, start small. It was only 130 units for us. We only had to raise $2.5 million, and we made mistakes on that deal. We overraised. We did a couple of the silly things that now in our second deal that we'll be closing in the next 6 weeks, we've pivoted. And we still made mistakes on our second deal. So you never will not make mistakes. Don't let mistakes stop you. Learn from those mistakes. That's what's important in life. If you learn from those mistakes and you just course correct, that will really help you out in life.
Yeah, I think that's a great point. I see a lot of, other people that are getting into it. It's like they're terrified to make that mistake. They reach out to the broker. They're worried that the broker is going to hang up on them, or say you don't know what you're doing. They're worried to make an offer because it might get rejected. And to me, it seems silly because I've been turned down on many offers, and I'm sure a lot of brokers hung up the phone and thought, well, who is this kid calling me? But so what is maybe the difference, or how do you see people get over the hurdle? You have a lot of students. So how do you see the difference in the people that can get past that? I don't care if the broker hangs up on me. Or
I'm going to unpack a lot of the stuff you just said there because it's really important. The first thing is we're taught not to make mistakes in school. I don't want to be a Robert Kiyosaki disciple, but if you really think about it, how do we learn in life? Everyone should stop after this podcast, look up the book, The Talent Code by Daniel Coyle. We learn by making mistakes. We learn by hard practice. And there's myelin in our brain, which connects our brain. I'm not a scientist, but if you think about it, you make the mistake, you really concentrate, you learn, and you do it again, and you do it again. You go to college for 4 years, you get a worthless piece of paper. You should be at least educating yourself for a year on this stuff before you get into it. You should be going to meetups. You should be talking to brokers. You should be going to RIA meetings. You should be going to live events. You should be on a platform, an educational platform like ourselves or someone else's, and really immersing yourself. It's all about your environment. It's all about how you're identifying with. And if you can't get that going, you're obviously going to fail and say, you know what? I don't know how to speak to the broker. As far as, getting rejected by a lot of people, they're not saying no to you. They're saying no to your offer. Separate that. That's the problem, that people think, oh, the broker said no to me. He's not saying no to you. He's just saying no to your offer. We have a piece of property that we're selling on the syndication. We have it listed for $295. Gentleman comes in, puts $100,000 all cash offer. Me 5 years ago would have been like, I would just said to the broker, I said, you know what? Thanks for the offer. That's the best offer I've had on this property. Unfortunately, it's a non-starter. So the guy tried, he's trying to fish. There's nothing wrong with that. On a multifamily deal, what I would do is you have these high offers. If you're going to put a lowball offer into a broker, make sure you send the underwriting over and make sure you tell the broker why you're proposing that number. That's crucial to save the relationship. I don't want you going out there saying the property's worth is listed for $1.5 million and I'm going to throw in a lowball offer for $800,000. Well, you better make sure the cap rate falls in line. You better make sure all your numbers fall in line to substantiate that price. That's what I would say to that. I think you all need to be educated. I think the most important thing is to learn to speak the lingo, Just follow somebody who's doing it. Success leaves clues, and you'll get so much more confidence when you're doing it. And it is a learning process. If you're investing in St. Paul, Minnesota, and you're afraid to call the brokers there, call the brokers in Orlando, Florida, and start practicing on those brokers, because you're never going to call them back ever again. Even if you sound like an idiot, it's okay. Record yourself. Have a script next to you. Know what to say to the brokers. I have a 45-question checklist that I give my students that they know what questions to ask. I have a 4-step underwriting questionnaire that when you're underwriting a deal, these are the kinds of questions you need to ask. When you first start out, you need to do that. You need to learn those questions. And as you get more and more practice, they become so second nature to you, and you become more confident. And the other thing is, get partners. Start talking to people. See who's interested in what you want. If you've got a hater who says you must be crazy, scratch him off the list. Don't even talk to real estate about him anymore. It's really important. My mom didn't know that I had 200 units in Tennessee until I told her. So I had a problem with her. I was buying property in Rochester, New York back in 08, 09. I couldn't scale up. And then she hears that, I'm up there. She's like, well, you've got kids to feed. You're taking a risk. And so every time I talked about it, it would always be negative. And she's not trying to put me down. She's just afraid for me, right? She loves me and she doesn't want me to see her. She wants to see me get hurt. So I'm like, okay, I will not say anything. One day, a year after we start buying with Jake, I'm like, Mom, I own 200 units. And she was like, how'd you do that? I'm like, don't you see me working every day, sitting here on, at the restaurant? I'd be having lunchtime and I'd be working. And she'd always say to me, you're working too hard. Why you work all the time? Life's not all about work. I'm like, well, I work 55 hours a week here at the restaurant. So what's another 10 or 15 a week, right? Just stay away from the people who are hating you. They're not hating you. There's one of two reasons we had talked about. They're either jealous because they would love to do something that you're doing, or they just don't understand and they're trying to protect you. So it was funny when I told her I'm finally leaving the restaurant. She was sort of shocked. She, and it was one of the best days of my life, to be honest with you.
Yeah, it's Grant Cardone talks about that a lot. The haters and the the reason and the psychology behind it. That book, the Be Obsessed or Be Average. The people who know me know that that's one of my favorite books, because it was really the first book that said the way that you think is okay. Everybody else is telling you you're crazy, but there's you think the way you do, and it's acceptable and it's all right. So I like that you pointed out that your mom didn't quite understand, because I know my mom in the beginning she struggled, because I left when my kid was born, and she said, well, how is that going to be a good example for your kid?
That is the example. That you're making a positive choice. You're making an empowering choice. So what other example is that than to do what you want to do, to follow your sole purpose? And my mom, it's not that she wasn't smart. She was an immigrant. She was very savvy, but she's more on the protective side. We have to stay small. Don't get too big. And, watch your words as a life coach, because your words are your actions. So when she says to me, don't scale up because you can have one restaurant, we can manage the cost. Don't get too big. Don't take too many risks. Well, you're going to be stuck there. And that's how I was thinking. That's how I was ingrained. Money doesn't grow on trees. You need money to make money. Yeah, you do, Mom. But now all of a sudden I can raise $4 million from other people. So it's basically, when you're surrounding yourself with those people, they're not hating or whatever, but you're taking those images and those thoughts into your mind, and you have to be careful and be aware of what's going into your mind. So that's why I'm always cognizant of what my environment is and who I'm speaking to. And if I don't like it, I just say, thanks, see you later.
Yeah, and I like your point of, I call it a throwaway market, but the Minnesota to the Florida deal that you talked about, it really, what can you be afraid of at that point? And I always tell people, look, I want you to just get it rejected. Like, that's your goal. So your goal is to fail, and that way, in my head at least, it takes some of that fear out of it. Just go get a broker to tell you that your offer is wrong and crazy, but like you said, when you said, tell them why you came up with your offer, a benefit that I see from that too is they're getting feedback from that broker. That broker is going to tell you, I think you're wrong because have you looked at this aspect or this aspect on the deal? And that could be a better education than anybody can give you, just being out there and doing it. So,
Reed, I'm going to give your listeners a golden nugget here. At least I think it's a golden nugget. The majority of real estate brokers out there don't really know what they're doing. Not in a bad way. They're just not trained in multifamily. They don't know cap rates. They don't know cash on cash returns. They're real estate. They're sales guys. They're trying to get a deal closed. Now, the top guys, the top 20%, they really know what they're doing. But the average broker, don't be intimidated by them, because some of them and our students are surprised. A typical example, you've got a broker who's selling a deal, right? One of my questions that I like my students to ask is, do you have any other properties for sale? One of my students asked the broker, he's like, I never thought about asking that question. How can you not think about asking that question? Because if the guy's got other deals down the pipe, maybe on this first deal, you might pay a little bit more with the opportunity to build rapport and get deals on the back end. So the bottom line is, don't be intimidated by brokers. They're just regular people out there trying to sell the deal and trying to close the deal. What they want from you is they want to see that you're a performer. They want to see that what you're going to say is what you're going to do. What you're looking from them also is you're trying to qualify them to see that if they're really an actual multifamily broker, or if they're selling their cousin's sixplex, and that's what qualifies them as a multifamily broker, because that's a lot. And a lot of the questions that you're going to ask: what are the expenses in this market? What's the per unit cost to buy the property? What are the preferred mixes in this area? What are the basically job drivers? Who's the major employers? What's the population growth? How many assets are there in this market? These kinds of questions you start asking them, they're going to qualify you as, well, this guy knows what he's talking about, and oh, by the way, I better know my stuff too. So you're always out there qualifying each other.
Yeah, that is fantastic advice. So I'm going to go back to your first deal. We talked a little bit about, you got owner financing on that one, correct? The 25 unit?
I got 10% owner financing on it, yes.
Okay. So, how did you think to ask for that, or how did you get to that point?
Great. That's a great question. Not many people have asked me that. And I think I just bashed real estate brokers. And now I'm going to say that they're also awesome, because the broker that we had there was an older guy. He'd built apartments. He owned apartments. He ran them. And we're still using him to this day. He's awesome. He just said, hey guys, I think we can get some owner financing on this deal. I knew what it was, but I really didn't know the strategy. I love Fixer J, the SEMA. So I said, you know what? Okay, how do we structure it? So it's really all about, how is it beneficial to both sides? Now, you need a motivated seller. You need a property that's a little distressed. You're not going to get on a Class A property where the guy doesn't have to sell. This was a C minus property. It was a 25 unit. Mixed use. It had a 6 unit efficiency. It had some cottages, which I love. It had a 4plexes. So it was scattered. It had weekly renters, which was a big problem. But more importantly, it had 2 owners, husband and wife, that were burned out. They were the typical, what we call mom and pops. They wanted to sell. They wanted to retire. It was on LoopNet for a couple of years, listed at $750. We came in. Rick says, let's offer owner financing 10%. Now, the bank who had the mortgage said, you know what, we can do that. We know this property is performing. So that really helped us out. And the funny thing was, we had gotten crappy terms, but we had gotten the owner financing. At the time, the interest rate was 6%. We got a 5-year term on the property. And when we refied it, rate went down to 4.19 with a 25-year AM. So our mortgage stayed the same. We didn't finance it right on the front end, but we financed it right on the back end. And the buy right in the beginning was, I think, what did it come out to, $24,000 a unit, which was really good at the time. We knew that there were so many expenses on this property that we could cut, and we knew that the tenant base had to be repositioned. That was the biggest thing on that. And the other problem with the property was it was a little bit older. It had needed a lot of deferred maintenance. We took over 4 months later, the septic systems failed, so we had to put 10 grand into that. That's why it was scary for us after to say, wow, if we don't raise enough money, or if we have investors and we can't pay cash flow for a couple months, that's really going to hurt us. So that was the limiting belief from that property. But it all started with the broker talking, to sellers and saying, well, what are you going to do with the money? These 2 individuals were just going to basically put the money in the bank. Well, what about if we offer you an owner finance deal where we can pay you 5% on a note? And they're like, you know what? We can do that. So, and explain to them the benefits of it, and everyone's got to be on board. And that's how it worked out for us.
Yeah, that's good. So that first deal, how long did it take you to get? Because I really want to focus on, it wasn't just a switch that you flipped and you decided to buy a multifamily. So you took quite a while to get to that first deal.
We did. Me and Jake did. So what was happening at the time, I was buying the duplexes up in Rochester. I was already working with property management companies out of my market. I had been coached. I'd gone through a couple of coaching programs. So I already knew the majority of what to do. When my thing was, Jake had a lot of value because he was in the market. He was boots on the ground. So it was good for me to partner with him, and it was good for him to partner with me because first couple of deals, I basically taught him what we needed to do. I knew how to underwrite the deals. I knew how to talk to brokers. all that stuff I knew how to do. And then when we bought this deal, it took us, like I said, a long time to find it. And that's what happens when you find your first deal. All of a sudden, things change. You start to get that momentum, and brokers start taking you seriously. And 4 months after our first deal, we got our second deal. Was that a coincidence? I don't think so. The opportunities are there. You get better. You start running the property. We had our own property management company, so Jake started managing it. And what really convinced him was, remember, we took cash on the property first rent. Never do that. We took cash. What he did is he put the cash all on his desk when he got home, and he was talking. He's like, people are paying me. You know, a W-2 employee to now people are paying you. It's a big mind shift. The biggest problem we had on the property was the weekly renters. You know, it's funny how people will pay $150 a week or $500 a month. And weekly renters are just, you know what? They're breathing. They've got, you know, they can fog a mirror. They were renting them in. They had no systems, mom and pop. They had no website. They had no maintenance going on as well. They just let anybody rent the property, and you know, you were getting more cash up front, but the turns were expensive. Every time somebody left after 2 months, you had to continue to turn the property. So that's where we saw value. They were paying the cable bills. They were paying all their utility bills. They thought that they needed to give that to the tenant to be able to rent. And slowly but surely, after about a year, we were able to clean up the property up. Took time. We were able to rent out some storage sheds in the property also, and we were able to really bring it back to what it, you know, to what it used to be. It was a nice little quaint property, but it took some work. It took a lot of work for us to do that.
Yeah, so you kind of touched on this a little bit. You know, we talk about managing, right? It was your second part of the system, and
Mm-hmm.
so you know, you talked about the mom and pop. They were just burnt out, but I think you just explained why. Is they had no systems in place. They were just it was just a place that they were collecting rent from and hoping everything worked. Um, and of course, that would burn anybody out. I think I don't think I could handle all that stress. But part of your system of creating the management, where you know where all the systems are in place, either by a third party management or you know if you want to take that on yourself and do a very good job at it, which I think you're a fan of doing it yourself.
I do. And, you know, the thing is, it all depends where you're at. If you're looking to get into your first deal and it's in your market, I would manage the property for multiple reasons. First thing is you're going to get a nice little rip every month to manage the property. Why pay a property management company when you can do that? That can help you become financially free a lot quicker. Second thing is it's always good learning by doing. We just mentioned that. You're going to make mistakes with property management, but you're going to learn the systems. And it's really cool to learn those systems. And then, you know what, after 6 months, if you don't like it, it's not your cup of tea, you can always go out there and find a property management company, but you're going to know what's going on with the property. And that was just one of our multiple streams of income. We've got that management company that we're vertically integrated. We manage our own properties. And now with the syndication company, we're able to manage our properties and get an asset management fee on top of that. So it's one of the layers of, of business that you can create. And who's to say after you've got 60 or 70 units, you create a property management company, why can't you go and actually partner up with a brokerage company and say, hey, listen, let's team up. Let's create a property management company. You run day to day and we'll split revenue somehow. There's a way to do that. But if you don't know how to manage the properties, how are you going to do that? So I love to manage properties. I love it. It's a great way to learn.
Yeah, that's interesting. So yeah, you know, part of the fear I think of managing your own is that you become that mom and pop that isn't properly screening tenants. They're
You learn that. You have to learn all that. All those systems you have to learn. And like I said, when you want to, a lot of real estate agents, a lot of property management companies want to get into the multifamily space. What better way than to offer them part equity for them to manage your properties? So they're going to get equity in a deal and you're going to get a property management company who can run day to day. I mean, that's a marriage made in heaven to me if you find the right management company out there, because a lot of them have that same fear. Like, I can't buy a multifamily. I mean, they're managing them. Why can't they own them themselves? I mean, the successful ones can do that. And as people start syndicating and getting into bigger deals, you can become the management company for these syndicators. They are looking for great third-party management. Sometimes it's hard in some markets to find this. So if you're in Des Moines, Iowa, or wherever, Louisville, Kentucky, or Chattanooga, and you're looking to get into one of these deals, maybe you get a syndicator who's doing a deal and say, listen, I'll manage the property. I'll be boots on the ground. There's worth some equity on that thing. There's a little piece of the GP that is really valuable to somebody, knowing that maybe you charge a little bit less and you keep a tighter, rein on the ship, and you can really manage this thing more efficiently than someone who's just doing third-party management. So that's a great way to get into multifamily for somebody.
Yeah, I like that's a fascinating point you talked about partnering with a broker. Can you delve into that a little more? What your thoughts
Sure. I
are?
mean, we've never done it, but I mean, our broker on our third deal held a note for as part of his commission. So my partner, he was a hedge fund guy. Numbers, numbers, numbers. We were $50,000 off on a $4 million deal. I was like, Jake, let's just. I'll beg, borrow, and steal. The broker took a note. He basically took a note for $50,000. We paid him $300 or $400 a month for the next year after we refied it out. We paid him back his $50,000 note, and he knew that we performed because it was our third deal that we had together. I mean, partnering with a broker, when you do the deal, maybe you have an acquisition fee and you guys can split the acquisition fee and just start a partnership. I mean, that's how we've done with all our businesses. We've had the education company, which is Jake and Gino. I do day to day. We've created a syndication company now, and we've brought on somebody to run that. So it's me, Jake, my partner Mike, and another guy named Dylan, who's head of investor relations, just created that company. And he's basically running that deal. He's dealing with the investors. He's putting the webinars together. He's dealing with the PPMs and all that. And he's also underwriting the deals. As that company grows, we can scale that out and hire more employees. But there's no way that I could do that work, and there's no way that Jake could do that work. So I see the pie as small. I'd rather split that pie up and share it with more people. So if there's a broker out there who's got a skill set to property manage, approach them. Say, hey, listen, why don't we partner up? And you know what? Instead of charging me 10% to manage, maybe you charge us 5% to manage. But you'll have a little equity in this deal, and you can start creating wealth for yourself also.
Yeah, that's, I think that's my favorite part. I keep telling my wife about the whole system is putting the pieces of the puzzle together. If you don't have one part of the system, it doesn't mean you can't do the deal. You just find somebody that can provide that for you. It's like you're building the system to create the purchase of, whatever unit you're working on. And that's my favorite part, I think, for sure.
It's funny you say that, and it's hard for people to understand that, but read the book by Bob Berg, The Go-Giver. It's really about when you're stuck and you want to become financially free. Once you become financially free, you understand it. The more value you add to people, the more money you're going to make. So if you have a 60-unit property, you've got 60 tenants, you're going to make more money than the guy who's got two duplexes. That's just the reality. That's just how it is. If you're a property management company and you're only managing 30 units, well, that's all you are. But if you can start partnering up with people and start buying these deals, you're creating value for somebody. Somebody's looking for that service. If you're a syndicator and you're syndicating 500-unit apartment complexes and you're getting 50 or 60 investors, you're going to make more money because you're getting a deal for 50 investors as opposed to a guy who's just buying deals by himself at 3 units at a time. It's just how it comes down to. If you can scale up and provide more value, you're going to make more money in this economy.
Yeah, so that's kind of the whole point of syndication is just taking the resources of a lot of people, and so maybe if you want to talk about how you got into syndication, what made you decide to get into that, and some of the hurdles of that, and what the benefits are.
That's a great question. We can spend an hour on that. The problem was you start running out of money, right? You just do. I mean, after 1,000 units, after refining $9 million and continue to buy, you want to go bigger, right? So for you to go bigger, you need more resources, you need more balance sheets. We have the systems in place, and we're like, you know what? Let's just try it. And the way I learned syndication, real simple. I podcasted all the syndicators, and I learned syndication through my podcast. And then obviously I got on calls with attorneys. We hired this guy, Dylan, that he knew a little bit. He's a young guy, but he still knew a little bit. So we put all our mind together. And the next thing is, let's go find a market. We focused. We found Louisville, Kentucky. Let's find deals in Louisville. And the important thing is, when you're a syndicator, you really have to be careful with the numbers. You really need the numbers to work because you can fall in love with all the fees. You can fall in love with the upfront acquisition fee. You can fall in love with the asset management fee. You can fall in love with the catch-up provisions where you're getting a little cash flow from the deal. Don't worry about that. You need to focus on the deal, make sure that the numbers make sense, and make sure there's a value add component to it. The pros to it, I mean, they're great. The tax benefits of them are great. The ability to scale up is great. The ability to not put any money down. Sometimes, the most times, we've put money on the limited partner side, so we've put money on the LP side. But as far as putting money for the GP, you don't have to put money down on it. You get 30%. We're getting 30% of the deal. Now, people are like, that's not fair. But the flip side is we're doing all the work. You're completely passive. We're talking about the deal. We're running the deal. We're signing on the debt. You have no non-recourse. If this goes bad, it's on our balance sheet. We're in big trouble. So we're taking a lot of risk on it. So there's so many pros to syndication. The ability to scale up and to really get some, sizable assets. The 130 units we bought in November, now right down the road, 10 miles down the road, we're buying 240 units. So now in the span of 6 months, we have 400 units in a market where now we have 5 maintenance guys, we have 4 leasing agents where we can share between those 2 properties. That's a real business. That's what syndication is all about. And then you create that property management company where you're getting asset management fees from it. There's another revenue stream there. So that's the exciting thing about syndication. The not so exciting thing is you need to be comfortable with taking money from people. You need to be comfortable to going into a deal, not having the money in the bank. Basically, we don't have $4.5 million in the bank, so we better be able to raise that. So it took us a little time to cultivate all those relationships. We've had a couple of live events and we've grown the investor list tremendously. But then after it's grown, you need to cultivate those relationships. You need to create substantive relationships with everybody. You need to get on the phone and find out what their investment goals and objectives are. It takes a lot of time. I wouldn't have been able to do it unless I had, we had hired Dylan to do that part. And it's a lot of fun, but in the beginning it's scary because you're taking money from other people. And, obviously you're putting your own money in the deal also. We are, but still you lose money for other people. It's a scary thing. I lose my own money. I've lost a lot of my own money. I've never lost anyone else's money. So it was a new thing for me, but I know we bought right. The 3-legged framework is buy right, manage right, and finance right. We're managing these things right because, rents we took over at 525, they're at 695 right now without very light, we knew we bought these things right. So the income was already I think the income was at 55 a door around, we're already into the low 70s on the income. We're up big in 4 months alone. So we know we've bought that right, but it's scary taking money from people and not knowing the outcome.
Yeah, I bet. So, one of the biggest things I hear from people when you talk about syndication is they're like, well, who do I know that has 50 grand just sitting around? So,
Everybody.
Yeah. So tell us, so I think I'm a little familiar with that, but for those that are not, that are thinking, everybody I know works at, makes 60 grand a year. They're not going to have that set aside, but why do you think that may not be the case for most people?
Well, it's funny. That's one of the reasons why you need to join an education. You need to join a platform because we teach our students, go to meetups, create your own multifamily meetup, get out there and start talking to people once you're comfortable about it. You don't need to own any properties. You just need to go out there and start talking to people. Most Americans have 401k. So you can have them put money into a self-directed IRA or more, I like the solo 401ks where they can invest in your deals. I probably think about half the money that syndicators raise is from that platform. That money's out of sight. It's out of mind. They're not going to see it. They know it's locked in for the next 20 years. Why not tell them, listen, you're buying an asset. We're going to give you whatever your preferred rate. We have an A-pref on our deals. We're going to give you an 8% guaranteed rate of return. What's better than that? You're getting 2%. In the stock market, it's up and down with all those fees. With this, we have control. We know what we're doing. So people do have money set aside. And it's like I said, the other thing, you start small, you start raising money from a few investors. And then after that, those few investors, once you've returned their money and you're doing a good job with them, they'll tell their friends and then they'll tell their friends. And then it starts. And then you start a podcast and you start talking about investing on a podcast and you start a little blog. And then you start going on other websites like Bigger Pockets and Flip Nerds or whatever podcast website you want to go on and start giving out, I wouldn't say advice, but start talking about real estate. People start seeing you as more of an expert, as somebody who they want to trust and like, and then that's how you start building your list out.
Excellent. Well, so I feel like we've provided quite a bit of content for today. Is there anything you think we missed that you'd like to hit on, or any advice you could give somebody?
That's another hour question over there. So
I won't just a high level.
Yeah, I'll make it. Short. Basically, you just have to know what your why is. If you can figure out what your why is, you'll figure out how to do it. Multifamily is a great vehicle out there. It's got great tax benefits. It's got, forced appreciation. It's got the control. It's got the ability to scale up. And more importantly, it's a business. Look at it as a business. Don't look at it as just fixing toilets. We had touched on the multifaceted. We call it multifaceted multifamily, where you start with a little 25-unit property, 5 years later, you've got this enterprise that's really growing. We have a little mortgage company. We're doing mortgages for our students. We're doing the syndication. We've got the property management. We've got the education. And now we've created a company, Rand Cares. We're actually having a charitable arm of the business also. So it is a business, and it's just, you have to learn how to run a business. It's not hard, because you see a lot of these guys out there doing it. You learn some key fundamental principles of business, and anybody can do it. But I love multifamily for all those reasons.
Well, very good. So we talked, we mentioned quite a few times about, coaching and various education programs. So if you want to take a minute to discuss kind of what you offer and what you have for everybody.
Sure. Well, first thing is just go to jakeandgino.com and just go jakeandgino.com/Gino. Just connect with me on LinkedIn, Facebook, Instagram. There's a lot of stuff. We put a lot of content out there. We have a blog at jakeandgino.com. Go check it out. A lot of free resources. We also have a podcast called Wheelbarrow Profits. It's the #1 multifamily podcast. We've been doing it almost 4 years. The majority is multifamily, but we do, interview a lot of high-level business guys. It's all about performance and business building also. We have a book on Amazon called Wheelbarrow Profits. We're having an event in October 19th and 20th in Orlando. Last year we had it in Nashville. This year we're going to expect about 600 people. So it's going to be a great live event. This is going to be a lot of fun. We're going to have all our team members. It's a Saturday and Sunday. We're teaching the buy right, manage right, and finance right. We have all our team members out there, all our vendors out there. It's a great place to network with multifamily investors, bankers, brokers. I'm there. We'll be there. So if you have any questions, my email is gino@jakeandgino.com. And it's never the wrong time to get into multifamily. Everyone always says, I need to save up money. I need to wait for the market to correct. No, you need to get educated, and you need to learn to when that market's going to correct. Because if you don't know when, it doesn't make a difference. You're going to wait to save money. It'll never happen. So decide to do it now and start getting ready for it.
Excellent. Thanks for coming on. I really appreciate it. That was a phenomenal interview. I hope it went well for you. And, reach out to Gino on Jake and Gino. I'm sure it'll be well worth your time. So,
Reed, thanks for the opportunity to speak to everybody, and I hope you all have a great day. Thank you.